Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today I'm joined with Jen Richardson, an experienced accountant who works with a large base of small business owners and individual taxpayers, including a significant number of property investors. In this episode, we shift the focus away from hotspots and shiny objects and look at property investing through a financial planning and an accountant's lens. We talk about starting with the end in mind, structuring ownership correctly from day one, and why so many investors only realise the tax and serviceability consequences after the contract is signed. Jen shares practical insights on negative versus positive gearing over time, diversification beyond property, the importance of a plan B, and the common mistakes the ATO is actively watching, from repairs and maintenance to loan redraws and refinancing. If you want to build wealth, not just chase a refund and build a portfolio, this is essential listening. Let's get into it. Jen Richardson, thanks for joining me on Geared for Growth.
You're welcome, and thanks for having me, Mike.
It's a much anticipated spot, this. We've been talking about it for probably years now, but I'm very thrilled to have you cornered finally. Now, just to sort of kick us off, for people that haven't come across you before, talk to us about your area of expertise.
So my area of expertise is looking after small business contractors mostly, or small business mum and dad type companies. But also I have a huge number of individual tax returns here. So a little bit different to most typical accounting firms, where most accounting firms want to go after businesses and leave the individual tax returns to themselves. I actually wanted this for me starting a business when I was a manager at one of the big firms here in Newcastle. And I could see that individual tax return people weren't getting a great deal. You know, we were seeing so many mistakes in their rental property schedules or in their motor vehicle schedules by some of those mass producers of tax returns. Yep. And so I thought that it's a good opportunity to give that service to individuals so that they can get the best result from their tax returns. And so I've built up a huge, and our fee base here would be 50% businesses, 50% individuals. So definitely not your typical accounting firm of the size that we are. But I'm really happy in that I know that I'm giving a good service to people. They're getting a good tax return that is accurate, not necessarily the greatest return that some of those other firms might get, but I want my returns to be completely accurate and know that they can put their head on a pillow overnight and rest easy. They get that audit letter, they're not going to have the panic, because, you know, everything's great when you get a refund until you've got to pay it back with penalties because you've lodged a false return.
That is a funny thing, isn't it? Because people often sort of say, like, oh, is my accountant good or bad? Really based on what they got back. And if it was more than the previous accountant, that's a better accountant, right? But that doesn't necessarily match reality.
No. And look, ideally, we say to our clients, if you can get back $1, you've done really well, because I always look at it that you are going to give your money to the tax office completely interest-free for the period of time that your employer's taken it out or you've paid it, until when you get it back. So ideally, particularly in the cost of living crisis that we have at the moment, you want as much money in your pocket day to day rather than getting that big refund back at the end of the year. And, you know, we see strategies all the time where people are paying an extra $100 in tax voluntarily so that they get, you know, a great refund at the end of the year, but they would have been better to have taken that money and put it off their mortgage, which you can do with your employers now, and get them to direct that $100 into your mortgage or into an investment to make your wealth grow. So I think as Australians, we've made it into a sport, what's my refund and how big a refund can you get? And I always say to clients, I can get you a much better refund if you pay me $10,000 to do your tax return. I'll guarantee to get you a better refund than you paying me the $200 or $300 that you pay me. So we always try to have that educational piece. It's about what's left in your bank account is the good bit, not the refund. Because, of course, your refund is only ever part of what you spend back. You don't get it all back.
It's funny, isn't it? It's almost like a forced way of saving for people. It's almost like a person's way of having a company dividend. It's like, here's a big lump of cash, like, yay, we'll go and you know, almost certainly they're going to spend it on something a little bit discretionary. But Yeah, so I suppose like the way I want to sort of take the benefit of that is that obviously you have a huge amount of people that are coming in doing these tax returns, and a reasonable cohort of them will be property investors. So I wanted to sort of pick your brain as an accountant because I think property investors, especially at the moment, are getting so wrapped up in the hot spots and building the portfolio and really just going, okay, well, when do I get the next one? And how do I open up serviceability? And how do I maybe force some equity to go again? But through an accountant's lens, where do you sort of see I suppose, points where you kind of wish those people would maybe pause and reflect and think about the strategy and the consequences of just having that laser focus on build, build, build?
Yeah, so we always say to everybody, start with the end in mind. What is your end purpose of getting these rental properties? Because again, you're going to pay interest to a bank. Yes, you get, roughly a third of what you pay in outgoings back, the net outgoings, but you need to think, what is your process? So if it is to build a portfolio to give you a retirement income, you need to either make sure that your debt's gone, or you need to be prepared. Which properties am I going to sell to pay off the other debts if you want your rental income to be your source of retirement income? And so we need to keep that laser focus of, what is the end goal, firstly. But secondly, you don't want to just go getting properties after properties after properties if you haven't thought about where you're investing. And we always say to everybody, when you go into the market for rental properties, it's really important to take a view thinking with your head, not your heart. Because, of course, we buy our own property very differently to us buying an investment property, because we'll buy a property that suits our lifestyle. I live close to the beach. I've got a husband and two of my three boys surf. So for me and my family, it was important to have a house that was close to the ocean. Well, that's not for other people. Other people might want to ride dirt bikes, so it's important for them to be where they are. So we buy our own property with our heart. What lifestyle do we want? Do we want to be near family, friends, and, all those sorts of things? I always say to everybody when they are thinking of buying a rental property for their own purpose, to think with what's going to give them the best outcome financially, because everything we should be doing is financial. So what is our rate of return on that property? Because you can go and buy a $3 million property in Merriweather, or you can go and buy a $1 million property in Maitland. What's the rent you're going to get? And come down to, collect your total net profit. So, your income less all your expenses. What's that as a percentage of the value of the property that you're buying? It's lovely to say that we need to look at properties in areas that are going to grow, but we really don't know what those areas are going to be. I mean, we have an idea, of course, but there's only got to be one change in that environment that can change the price of properties. So you've got to really work with what you've got now as a solution. So look at whether you've got a good rental market. So look at what rate of return you can get. So also the value of the tenants that go in. And I don't mean that to sound egotistical, but there's certain areas that you wouldn't want to rent in because they don't have that same care and control of your asset. And of course, you put with a rental property, you put your investment in somebody else's hands that you have little control over for the period of the lease. So you want to make sure that they're a tenant that's going to look after your property.
Yeah, that's an interesting way to think about it, because I suppose investors would just think about yield, but as a percentage of the purchase price, what is the end sort of net outcome is a way more sophisticated way to look at it. Speaking of sophistication, I've heard this from accountants before, and I'm wondering if you have exasperated moments where people come to you at the end of the financial year, do their tax return, and they say, oh, by the way, I bought a property. And perhaps you'd wish they'd maybe sent you just one email first for the little name that goes on the contract and perhaps a whole host of other reasons.
Yeah, that's right. I mean, once you've actually bought the property, you can't change that ownership. And some people will say to me, oh, that's okay, we'll put 80% of our income into my partner's name because they're on a lower tax bracket or anything like that. And you can't do that. It has to go out in the title of the property. Or we have other people that'll say the property's all in one person's name, but the loan's in two, so therefore we can split it. And they're not. They're two different scenarios. So it's about knowing what gives you the best tax advantage for the now and also at the other end, because there's lots of advantages while it's being rented that might be a disadvantage at the other end. If you've got one that's a high income earner and one that's a lower, we might go 80% ownership into the higher income earner if it's negatively geared. But then once the property is no longer negatively geared and it becomes positively geared, it would have been better that it was a 50-50. So it's about doing the forecasting. I always say to everybody, it's not just the now. If you're going to plan on holding this property for 10 years and in 3 years' time it's going to be estimated to be positively geared, what do we do for the other 7 years? We might have it the wrong way around. So let's look at the whole picture. And that's where we always say start with the end in mind as well, because if you're planning on, rolling this over and getting more rental properties, perhaps we would be better off to look at an entity to put it into rather than your own names. And also the capital gains at the other end. Whose name are we better off to have that in?
Yeah, gosh, that is an interesting thing, because I suppose if we've got our heart set on a particular property, and most properties in the current environment would be negatively geared, it makes sense to throw that at the high income earner. I'm like, yeah, they're getting the best benefit. But eventually, over time, if you are like a normal buy and hold property investor, that actually becomes a problem, because then their higher income just gets even higher. And I'm sure that there are a lot of people that don't think about that. And I suppose people listening to this show are probably on the same page as myself and many other people that just say property is the best asset that you can buy, just because of things like its ability to be leveraged, and just the history of property growth in Australia. It's such a tangible thing. I think it is really part of Australian culture to covet property as homeowners and investors and that sort of thing. But it's not the be all and end all, right? And there are other things that people need to understand, like not just diversification, but things like super and the tax benefits that you get by taking a little bit more of a holistic view than just going straight into the property. What do you think people are missing when they're just hell bent on growing the portfolio?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
I think the thing that I see mostly is that they don't not only diversify, and of course, I'll put my financial planning hat on because, I might be a retired financial planner, but it still lives in my brain. Diversification is everything. Have a little bit, because when one market's up, another market will be down and vice versa. But we also look at with property, you can't take a bedroom shopping. And if you go into financial duress because somebody's lost a job or, the circumstances in your family, you can't just sell off part of your investment. And even if you could sell a rental property tomorrow, it's 6 weeks before you've got your funds. So I always say to everybody, make sure property is only part of the portfolio that you have. It might be putting more into super to build your wealth, or it might be having an investment into an ETF or share market, or even fixed term interests, so that you've got something that can be liquid very quickly should the unforeseen happen. And look, one of the things that we always see is the Australian markets always pay your mortgage as quickly as you can. And sometimes that's not the right solution. Sometimes you might be better off just to stick to that 30-year payment plan, but use that other surplus money to have some other investment somewhere else, so that should something happen, a tenant leaves and you can't find a tenant for a little while, you've got other sources of income to pay the mortgage rather than just your own wage trying to pay those mortgages as well, because that's a really important thing, that you've got a plan B if anything happens in your life, so that you're not going into that financial duress that so many people do. And of course, as we know, when you go under financial duress, you don't make good decisions. So you decide to sell a property in a market that's not great to sell it in, or you sell investments that you shouldn't be selling. So, sit with an accountant or a financial planner to work out what sort of repayment schedule you should have. The other thing, of course, is if your plan is that you want to get multiple portfolios of investment properties, what do you do with the savings for it? You can use your equity in them, but you still got to have that serviceability. So, we always say, make sure your loans are set up correctly as well. Offset accounts or redraw accounts, what do you do with all those sorts of things? And so that's talking to your accountant or your financial planner to make sure you have everything structured correctly.
I often think about the statistics that 72% of property investors only ever own one property. And once you go above two, you're in very, very rarefied air. You're in like the top 10%. I wonder if the reason that number has never really grown and it's sort of stuck around there is really about that plan B, not necessarily having diversification, not necessarily considering a serviceability buffer, or just planning for the fact that you could lose your job for a period of time and maybe it takes a couple of months to find an equivalent thing. Do you sort of feel and see that when you're talking to clients?
I think it's more, for me, the serviceability. It gets to that point that you say, well, how many years till I retire? Because, of course, the first thing that most of us buy is our own home. And I see it a lot with people then want to upgrade, and so they go and buy another one and turn their first home into an investment property. And so that's how they tend to fall into the market, a lot of people. And so once you've got this home that you've obviously upgraded for your family's needs, it does become a real serviceability issue, and they start to panic and, how many years till I retire? And that's where I said at the start that you need to look at the end in mind. So I've had clients that have had 3 and 4 properties, and so you're right, they're in a rarefied area, but they go into that 3rd and 4th knowing that one they don't want to pay anything off because their plan is just to sell it at retirement to pay out the other ones, but get those tax benefits along the way. And so the strategy of how you're going to do things is important, because if that's your plan, then it's very different with what you want to do with the mortgage repayments and things like that. And that serviceability does come in to play then, because you've got a number of them. And, the thing that I find is when one of the properties of that person then is not rented for a period, they then have the doubt with their strategy is right. And so you need somebody in your side to go back to go, this is where this is the plan we had in place. We knew that there might be periods of time that this property might be not rented for it. Now we're enacting our plan B. So to keep you in that calm, but everybody's default when things go wrong financially is panic. Rarely does anybody go back to their plan B that they had and go, you know what, we planned that this might happen and now it's happening. So, what we put in place was really good. That does, of course, rely on you having that plan B in place to start off with, which most people don't. Everybody goes into a rental property that, this is, because all due respect to real estate agents, when they're selling you that property, they're not going to give you the negatives of buying that property. You might have, this area might have a vacancy rate of, 10% over the year. And so you need to find that out when you're buying the properties. I give my clients a list of questions to ask the real estate agent. What's the tenancy rate here? How often does it turn over? People in this area only staying for their 6-month lease, or do they have long-term leases and all of those sorts of things? So it is important that you have that plan B in place, but then to have the calmness to go, this is now just putting my plan B in place that I had and move on. But that's where I find people panic and they don't go to the next one because it just got too difficult.
Yeah, and as you say, the panicked brain is not the best brain to be working with for making sensible decisions. And again, I feel like it's come up twice already. A plan and a strategy. It sounds so simple, but there's so many people that just like, I've got to go and buy something in Ballarat because it's booming, or I hear Darwin is going gangbusters, so I don't want to miss the train on that. And the strategy is something, we'll figure out that later. But as you say, there's some things that need to be figured out at the time that you're buying that property.
Yeah, and it's interesting because people are going into the share market. They would talk to somebody of knowledge. They wouldn't just go, I like Commonwealth Bank or BHP or Westpac or whatever. But when they go into rental properties, because everybody's already bought their own home, or home ownership's an easy, and we have this expectation that we should know. We should know everything. You just buy a property and put a tenant in. It's not that simple. And, it's one of those things that because it is simple to get into it, and we don't need any experts. Everybody thinks they don't need the advice beforehand.
Well, we bought our home. We've lived in homes forever. We drive to work and we go past homes, so there's this implied knowledge because we're so intimately familiar with being in and around them, but investing them is quite a different thing. I wanted to check on a couple of things. One is sort of a bit more the macro sort of property investing environment, but to niche down a little bit, the ATO every year tend to sort of come out with roughly similar statements. We're looking at repairs and maintenance. We're looking at non-deductible debt, so equity redraws to buy a car being deducted and those sorts of things. As an accountant, what are some of the things that you're seeing people falling foul of, and what does it feel like the ATO is kind of looking at? Because obviously the government's been chatting about CGT changes, that they've been spending a fair bit of money and they want to claw it a bit back, and they feel like property investors are a good people to go after.
Yeah. So obviously every year the tax office look at repairs and maintenance because that is the area that most people will fall foul of. So a repair is putting something back to its original state without improving the product. And we always say to everybody, a nice simple way of looking at that is if you replace one door in your kitchen, that's a repair. You replace all the doors in the kitchen, it's an improvement. Or, the fence, if you replace one panel of the fence, it's a repair, replace that thing. But we have people say to us all the time, the water pipe was leaking behind the shower, so I had to pull all the tiles off. And of course, you can't just retile one wall. It doesn't matter. The end result is an improvement, even whatever caused it. And so the tax office will always be looking at repairs and maintenance, and things have changed over the years. They used to just put one line in, repairs was $5,250. Now we have to break it up, and the tax office see that breakup. So electrical goes in at $3,250 of that $5,250. They're going to look at that and go, well, that's not fixing a PowerPoint or one light. That was probably rewiring the house, which is an improvement. So we've got to be very clear. You paint your house, that's fine. But if you do anything else, it's not. Pull up the floors and put down new carpets, well, you've got to depreciate it. You can't claim it as a one-off. So there's that. Other thing that they're looking at now is obviously the interest component. And that's their second biggest area of observation because, which is great. We're always encouraging people to refinance because we all know banks and insurance brokers are the same, or insurance companies, sorry. We're always looking to get out of that loyalty tax because, there's always a better interest rate for new consumers than it is for the existing ones. The problem is when people refinance, their mortgage brokers do the right thing and go, let's bundle it all in together. We can get that credit card debt or that personal loan into a mortgage rate. So whenever you refinance, the tax office is looking to see, did you increase that loan? So therefore, some of that interest may be non-tax deductible, because it is important to remember it's what the funds were used for, not what secures the funds. So it doesn't matter that it's secured against the rental property. If it was to buy the new car or for you to go on holidays, that purpose was non-tax deductible. The other catch, of course, is that we, as I said, Australians have this thing, we need to pay the mortgage as quickly as we can. So there's quite often redraw. People will go, I put all my money into it to save interest. Now I want to get my money out. Well, it doesn't matter. Once the money goes into that loan, it's trapped in that loan unless you use it. So, of course, there is strategies that we can do, and I've done this with clients in the past, that you start using your redraw to pay your mortgage instead of pulling money, and those sorts of things. You use your redraw to pay the council rates, the insurance, the water rates and things. So you're using that redraw to pay for property purchases, not for your own and what you would have put in there. So there is some strategies, but it is important to remember that that's a really key area that the tax office is looking at.
It was really interesting to hear that they're breaking down the repairs and maintenance stuff now. And in the world of large language models and data analysis and AI, presumably their powers to go down to the minutiae are getting better and better. It's also a little bit of a mystery about where their benchmarks are. I remember a number of years ago, there was a big article from the ATO saying that with a sample of property investors, we found 9 out of 10 of them had issues. whether it be incorrectly claiming interest as deductible and presumably repairs and maintenance and that sort of thing. I remember speaking to a lady at a tax software company who got a freedom of information request to get more data on that and found that the sample size was like under 1,000. So it was actually a little bit of a misleading article. How much do we get to see behind the curtain with the ATO? I mean, is there a hard sort of ceiling for electrical repairs that they're happy to say is repairs and maintenance? How much can we actually know what's going on there?
Yeah, there is no ceiling, and they will never tell you that. They just tell you something is either deductible or not deductible. So, I had, somebody come here today, let's say, and had a light fitting fixed, and then something else needed to be done. And, they look at the frequency of it. So you can spend $3,000 over the year if it was 10 transactions as opposed to one transaction.
Right.
And the problem we have with a lot of them is, somebody might say, I need to get the veranda fixed. So while I had the carpenter there, I got them to patch the hole in the wall and then fix up all these little bits and pieces. It's the breakup of that invoice, we say to people. And that comes back to, the communication with your accountant, because, we're trying to do a client now, for example, that it's a new client to us, got a rental property, we've got 3 or 4 years to go, and we've sent him back to somebody who did some work on his rental property 4 years ago to find the breakup of that invoice, because that's exactly what happened. He had the floor, had a new veranda done and then did all these other things. So when we look at the invoice has got some things that would be repairs and some things is what we would call capital. And I said to him, you need to go back and get the invoice broken down. Otherwise, it's all capital, because I don't know what that breakup is. So, the thing that we always say to our clients is, if you give us a call beforehand, we can give you the things, but trying to do everything backwards is really difficult. So my key message is always keep in touch with your accountant or your tax agent, or whoever your advisor is, but don't just listen to the market. The mate at the pub doesn't know what he's talking about.
Yeah, despite the confidence in which they're elucidating their intimate tax knowledge and knowledge of, property investing in the economy, there's no shortage of that sort of banter, is there?
Right.
But
and you've got to remember also, Mike, that with the tax office, people will go, but I always claimed it and the tax office allowed it. We're under a self-assessment system, and it's only when you get audited that you've got to verify. So the fact that you went through in your tax return doesn't mean it's correct, just means you haven't been looked at yet. Yeah.
It's a bit like saying, I've been stealing things from Coles for 20 years and only now it's an issue for you. Well, it's just, we haven't been allowing it. We just hadn't noticed yet.
Yeah, I'll remember that one from my clients.
Good. You can have that one. Now, I sort of referenced sort of the macro property investing market at the moment, CGT. Obviously, there's clawbacks that the government wants to sort of look at there. I think as recent as this morning, they're sort of saying that they're not going to touch that. And it's a typical thing that seems to happen every year. They float negative gearing or in CGT, or at least before each election. People like myself talk about why the reasons that might be bad for people that want a rental property to live in. And then we just repeat the sort of cycle. But is there anything that you feel like property investors should be keeping an eye on right now? Obviously, we've just had our 25 basis point increase. A lot of banks are predicting there's going to be another one later on. CGT's in the headlights. I think one of the big complaints of property investors is that it's for them, it's a 10, 20, 30-year investment horizon, but there's all this tinkering around the margins that makes them lose kind of confidence. Should we be looking at this, or in the grand scheme of things over 30 years, if we've got the structure right and we've got the property right, we should just let it be noise?
I always say, don't worry about don't try and control what you can't control what you can. And that's your investment, making sure that you're working towards that plan, exit strategy. You're never going to know what the government's going to do. I mean, we all know legislation changes. I mean, somebody that bought a property pre-1985 would never have considered that they would have to pay capital gains tax. So, we can't control what we can't control. So keep working on your game plan. Be in touch with your financial advisor or your accountant, because if things change, you need to put strategy, redo your plan B. And of course, if they get rid of capital gains tax, the exemptions, that 50%, which is what they're talking about, and that, you're right, comes out every election, and definitely every just before the budget, because they're testing waters. That's what the government do. They put it out there to see what the reaction is. And so we can't control if that has happened. We don't know if it'll be a grandfathered provision when it comes in, or are they going to say everybody backwards will be bound by this? But there's certainly strategies at the other end. And the thing to keep in mind is that, as you know, with the depreciation schedules that we get, that bites you at the other end as well, in that it reduces your cost base. But you take the nows and worry about the future when the future happens, because capital gain, when it comes out, you may be retired and it's not going to have a huge impact, or you might have money that we can get into super to reduce the effect of that capital gain. So take any advantages that you can get now to build your wealth. And, everybody looks at negatively geared investment properties particularly, because that's where most of the negative gearing happens, even though it can happen on any asset. They're after that for a tax advantage. And, that's the primary reason that most of them do it. But the second thing that you need to be always working at is this is a wealth creation. Don't ever do anything for a tax advantage, because you spend $10,000, you'll get $3,000 back off the tax office. You're still $7,000 out of pocket. But the wealth creation is where it happens at the other end, hopefully. And
it's funny, isn't it? We just love this idea of reducing the tax, and we're prepared to lose money to get it,
I said to somebody this morning, it's the greatest sport in Australia is trying to get rid of a tax. That's everybody's thing. But, in wealth things, you need to make sure your property's building by more than $7,000, using that example I had. Your property's value's got to go up by more than $7,000 a year to build your wealth, which it probably does. But you've got to keep the end game in mind, is that you want to build your wealth. Now, if I can sell my property at the other end for $1 million profit, I'm quite happy to pay a bit of tax, because I'm still better off financially. And getting that message across to people, it's the big picture, not the little picture of, oh my God, look how much tax I've just had to pay on this property.
It needs a bit of a reframe, doesn't it? Like we sort of fear the stick more than we covet the carrot, Like if you've got a big tax bill, that means you won, right? You made money, okay? They're taking a little bit from you because you had a great success. Yeah. But if you're getting a refund, it's like, well, you actually kind of lost a little bit, and unless there's something on the other side of that loss, like an appreciating asset, it is just a loss. To finish this off, Jen, I wanted to sort of maybe open it up to you in terms of the best advice for property investors at the moment, or perhaps even with the experience of all the people coming through your doors, the ones that understand it and are getting it right and are actually potentially really changing their future and their freedom and hitting those goals of what they're trying to set out for in the first place.
So obviously keep in touch with all your advisors, and then have that plan. What is the ultimate goal? I sit with people and I'll say to them, what's the ultimate goal with this property? And they go, I don't know, I just thought I should have got a property because, I get a rental income and things. So have that ultimate goal in place, work out what your plan is with it, and stick to the plan. And that's where I said before, when people go into that financial duress, they panic. You got to know that you've got your plan in place and it's there. So come up with your strategy, talk to your advisors to make sure the outcome is the best. And the other thing that I say to a lot of my clients is they will say, oh, the real estate agent said I need to put my property up $20 a week extra. It's not always the best advice, and I understand why they want to do that. But if that pushes your tenant to move out, you potentially have a month where you've got no tenant. Then you'll have a month where you lose your rent for the re-signing of the lease to the real estate agent. Is that worth it? And if your tenant's a good tenant, are you better off not to have that longevity and have that consistency of income and somebody who looks after your property, because the grass isn't always greener on the other side. So, don't be caught by the numbers. Think logically. And that's where I said earlier that investment properties, you need to think with your head, not with your heart. So the head is it worth it? Take the chance that I get a tenant that I don't know what they're going to be like. They only stay 6 months and leave, to chase that extra $20 a week. Talk to your advisors to find out how to structure your loan before you get the loan. Talk to your advisors before you sign the contract and get the home ownership right. Talk to advisors about who you get your quantity surveyors report from, because ultimately, as you'd know, Mike, you prepare it under the best that you can, but ultimately it's still the homeowner that's responsible for it. So be very careful, check out people. I've had clients that have said to me, I can get it much cheaper online. Have you checked their qualifications? Have you checked their history? Have you checked everything else? So, go into it like you would anything else and your due diligence.
Great advice, Jen. And it makes me just kind of think like it is actually pretty simple when you boil it all down to things like the strategy and the structure and using those advisors and starting with that end game in mind. So thank you for reminding us of that and some of those little tidbits and bits of gold as well along the way. Appreciate you coming on the show.
You're welcome, and thank you for finally getting me on.
We got there in the end. Cheers, Jen.
Thanks.